Welcome, everyone. We will getting started in about 1 minute. We're just waiting and give the participants another moment to enter the webinar. We will have an informative webinar today for you. I want to thank you for your response, particularly as many of you are likely enjoying the summer and take the time now. So let's give it 1 more minute. Thank you again for those who have already joined. We will be starting shortly. Again, welcome everyone. Allow me to review some technical logistics before I introduce our panelists today. We are recording this webinar and will be publishing it later. You will all receive a link to the recording later. We will have a presentation from Clark, followed by a brief commentary from Robert and me. Then we will open the last 15 minutes or so for questions from you. I guess there will be many of those. Please use the Q&A button on the Zoom bar to type a question and not the chat function. So please use the Q&A button on the Zoom bar to type in your question. We will endeavor to answer as many questions as possible. We intend to address these orally, so the chat function will not be open at this time to the audience. First, thanks a lot for attending. We had over 150 people responding to this webinar, representing a diverse range of sectors, including banks, pension funds, governments, asset managers, academics, and non-governmental organizations. This suggests that the issues of global LNG markets, including demand and supply, as well as the implications for investors, financiers, governments, and civil society, is a crucial and timely topic. I'm sure you will find today's presentation will be illuminating. Secondly, let me thank our co-hosts for today. Thank you to the Toronto Climate Observatory, based at the University of Toronto. Thanks to the Center of Excellence in Responsible Business, based at the Schulich School, and thanks as well to the Trottier Family Foundation. My name is Olaf Weber. I'm a professor at the Schulich School of Business at York University. I hold the CIBC Chair in Sustainable Finance, and I'm the director of the Center of Excellence in Responsible Business. Clark Williams, our presenter, is an energy finance analyst with the Institute for Energy Economics and Financial Analysis, IEEFA. Clark focuses on the finances of North America's oil and gas industry. His areas of expertise include global LNG market trends, the long-term financial performance of North American oil and gas companies, particularly those focused on fracking, and financial issues related to the cleanup of oil and gas infrastructure. Dr. Robert Soden is an assistant professor in the Department of Computer Science and the School of Environment at the University of Toronto. He leads the Toronto Climate Observatory. His work draws on human-computer interaction in science and technology studies to evaluate and improve the data and information that experts and communities use in responding to climate change and disasters. So I will now turn it over to Clark to begin his presentation. Clark, it's your floor.
Thank you, Olaf. Good morning, good early afternoon to folks on the call. Thank you for inviting me. I do have to say one thing in advance, which is that I woke up with a sore throat and a bit of a stuffy nose. I have taken my Dayquil. I will do my best to continue talking for the next half hour. But there's a chance I'll lose my voice. Who knows? Uh, my name is Clark Williams Derry. I am, as Olaf mentioned, an analyst with IEEFA, the Institute for Energy Economics and Financial Analysis. And for those of you who aren't familiar with IEEFA, we are a global energy think tank. We look at issues related to energy markets, energy trends, and in particular, we have a lens that looks at the transition to lower carbon energy sources. Now, one thing to note about IEFA is that we have, well, we do have a North American team. I'm based in Seattle and Washington State in the US, but we have analysts in Canada, in Europe, in Japan, South Korea, China, India, Bangladesh, Australia, Pakistan, and in many Southeast Asian nations as well. So our analysis is not just based on our own views from sitting in North America. It is actually based on careful market by market analysis with local analysts with expertise in their regions. The topic today, of course, is LNG, and the question of the hour is the tidal wave of new LNG supply that's going to be coming online over the next few years. Now, the presentation I'm going to be talking about is about the sort of potential glut of LNG, an oversupply of LNG, and that really involves both supply and demand, obviously. But I'm going to start on the supply side, which is where my expertise lies. This is a chart showing what we believe to be the trajectory of the build out of new LNG projects globally through 2029. Yeah, as you can see, 21 through 2024 were fairly lean years for new supply additions. Relatively few projects coming online, in part because of a glut that happened in the mid 2010s. That sort of basically caused a sort of a decline in new projects coming on reaching FID during those years. But in the coming years, from 25 through 29, we're going to see what we believe to be a 40% addition to LNG liquefaction capacity around the world. Much of that is going to be coming from the United States. We estimate around 97, maybe give or take, depending on a few things, but about 97 million tons per year of new capacity coming online in the United States from 25 to 29. Qatar will be adding roughly 56, again, give or take. There may be some acceleration of projects or delays of projects that may push that out a little bit, maybe a little bit more, a little bit less, but it's around 56 million tons per year. And in the rest of the world, of course, that includes Canada with its new LNG Canada project that has already shipped 2 shipments of LNG, and is the rest of which will be coming online later in the upcoming years. Canada's wood fiber project, the Cedar LNG project, but also projects in Australia and Russia and Oman and the United Arab Emirates, Nigeria, Gabon, Malaysia, Indonesia, Congo, and Argentina. All told, those will add another roughly 58 million tons per year of new capacity. And of course, just to make sure you understand, this is a chart showing only those projects that have reached FID or are under construction. This is not speculative projects. This is not proposals that somebody has sort of like waved around and said, we'd like to build this. These are the ones that have reached FID. And it doesn't include some projects that are arguably under construction. For example, CP2 in the United States is one project that is where initial construction has begun, but is not on this list because they haven't officially reached FID yet. So in short, what this shows is our best guess at the projects that have already been FID'd, but the actual wave of supply could be larger or smaller depending on delays. This is a chart that shows the existing supply capacity and when it came online, and compares that to what we expect to see in 25 through 2028. And as you see over time, the 2025 to 2028 bar is far and away the largest supply capacity addition that the global LNG market has ever experienced or will ever have experienced. As you can see, 21 through 24 was relatively low. This is also a period when there are upheavals in the global LNG market, especially the Ukraine crisis, which I'll discuss later, and Russia's curtailment of supplies of gas pipeline supplies to Europe. But from 2025 to 2028, the amount of supply that is scheduled to come online is more or less dwarfs anything that we saw before. And here's another view of the same basic trend, 25 through 28. I've sort of compared 4-year periods here. But there will be nearly 5 times as much new capacity, LNG capacity coming online over the next few years as came online from 21 through 24 during the period of the sort of the biggest LNG market upheaval we've seen. So this much new supply raises a large question, or a number of big questions about the LNG market. In particular, who is going to absorb all of the new LNG that's going to be produced from these projects? What is going to happen to LNG prices as a result of this new supply coming online? And what will the potential oversupply mean for the finances of the LNG sector? Now, I'm going to start by looking at questions about who might absorb this supply. And one place to look is the developed markets. And when I say developed markets, I mean mostly Europe, Japan, South Korea, maybe Taiwan. Um, this is a chart showing Europe's LNG imports. And as you can see, there is a huge spike in 2022 of LNG imports related directly to the Ukraine crisis and Russia's curtailment of shipments into Europe. First, there was a decline in shipments through the Yamal pipeline. Then we saw Nord Stream explode. All that capacity, those shipments were lost. More recently, the shipments through the Ukraine passages have been curtailed, and so Europe responded to this by importing a huge amount of LNG, basically backfilling at least part of the missing Russian supplies by importing LNG. And of course, as most people remember, this set off a global bidding war for a limited supply of LNG that was available at the time. And in particular, developed nations, Europe included, but also Japan, South Korea, were willing to pay sky-high prices and bid up the price of LNG to previously unheard of levels. What this resulted for developing nations was supply disruptions, unaffordable LNG in many places, Bangladesh, Pakistan. Even if these countries had contracted for LNG, they were unable to get it because their shippers were shipping the cargoes that had been contracted by these countries to Europe or to wealthier countries, and basically daring the Pakistani government to sue the traders to get back the value of the lost cargoes. But it was a very difficult time, not only for Europe, but also in the developing world because the prices were so high and the supplies were so unreliable. But as we can see in this chart, one of the results of sky-high prices in Europe has been a decline in European gas demand overall. We're still seeing fairly robust demand for LNG this year as it's lost a little bit more pipeline supply from Russia. But overall gas demand in Europe, in the EU and in Europe as a whole, has been falling largely due to the high prices, but also due to energy security policies, climate policies that are encouraging a reduction of gas demand in those economies. So as we've seen from 21 through 24, a decline in total gas imports when you combine LNG and pipeline gas is an 18% decline, roughly a 1/5 decline in gas consumption in the European economy over that time, and plans for continued build out of renewables and alternatives and efficiency measures that could, over time, allow Europe to satisfy its gas demand without increasing its LNG imports. Meanwhile, you might take a look at another place that has been the mainstay of the global LNG trade. In fact, Japan arguably created the global LNG industry because it wanted to import gas, had no domestic supplies, and no ability to get pipeline gas. So basically, the LNG industry was the brainchild of Japan originally, and Japan saw massive growth in its LNG demand leading up to 2014, particularly in the wake of the Fukushima disaster. After the 2011 Fukushima crisis, Japan started importing LNG, more LNG, or ramped up its imports in order to compensate for lost electricity supplies from the nuclear power plants that went offline. But that process more or less peaked in 2014. And we've seen since then that Japan's domestic demand for LNG has fallen by about a quarter. And there is the potential, and I would say even possibly the likelihood, that Japan's long-term demand will fall further from here, due in part to more nuclear restarts, but also long-term energy plans that envisions lower levels of LNG imports, as well as their aging demographics. This is a chart from the US Energy Information Administration showing the restart of Japanese nuclear reactor capacity over the years. And you can see that, for example, in 2018, the startup of a number of the of the nuclear plants following the Fukushima crisis also corresponded to a dip in LNG demand in Japan. This process is about halfway completed. There's about half of Japan's nuclear capacity is now online, but there's another half that is proposed to be brought online over the coming years, which could crimp the country's demand for LNG moving forward. Um, in summary, when we look across the major developed market economies, Europe, Japan, South Korea, these countries represent about half of global LNG demand right now. And we believe that there's a case to be made that their demand is going to decline, flatline or decline over the coming years based on their energy plans, the high prices that we've seen in the past that have curtailed demand, and just overall the gas demand trends in Europe, which appear to be in decline. So that leaves us a question about, well, if it's not going to be the developed market economies that are going to be importing additional LNG, could it be the developing economies, places like China and India, places that are still experiencing fairly substantial economic growth? Um, let's start out by taking a look at China. In China, what we saw from 2015 through 2021 was steady incremental growth in LNG demand from the Chinese economy. You could basically count, the LNG industry could count on an incremental 7 to 12 million tons per year of demand coming from China. And that just was sort of year after year, sort of a steady drumbeat. And that created this sort of, I guess, a narrative within the LNG industry that China's demand was essentially insatiable, that this trend would continue. But that trend was interrupted in 2022 by the price spikes, by the difficulty in actually securing cargoes in some cases. We saw China's demand for LNG drop precipitously in 2022. Rose again for the next 2 years. It's down again this year, another 22% year over year decline in Chinese LNG demand. And there are reasons for this. It's not just sort of like, it's not just prices, but China has been consciously prioritizing domestic gas production, including production from unconventional methods, that is sort of fracking methods. It's been prioritizing pipeline imports, renewables, particularly domestically produced renewables, solar and wind, and domestically produced coal over LNG. And so this it is, if we look right now at the trajectory of Chinese demand, it is looking far less certain that we're going to see incremental growth in Chinese economy. And in fact, looking forward, they still have plans to increase their domestic gas output. There's weak economic growth, there are trade concerns, there are energy security concerns, there are LNG pricing concerns, all of which are pointing to a reduction in the pace of growth in China's LNG demand looking forward. And I will get to coal in a second, but one thing to note here is that coal does not appear to be a significant contributor, or the decline of coal is not a contributor to LNG growth in China. There's no evidence that either that China is replacing coal with LNG or even that China's growth in coal consumption is in decline. Um, let's take a look at the other Asian behemoth, India. Again, the what we're seeing in the power sector is that gas demand is in decline in India. This bucks the trend that the LNG likes to talk about, LNG industry likes to talk about, which is that there's substantial growth in demand in the power sector in developing Asian economies for LNG. This does not appear to be happening. In fact, in India, the power sector demand for gas has been in decline. It's actually fallen pretty substantially from 2016. There's no plans to build new gas-fired power plants, and in fact, the existing gas-fired power plants have a high stranded asset risk. Just in January, for example, the fleet utilization in the Indian power industry for the gas-fired power plants was about 8%, which is a tiny share of the gas capacity that was being used. And the reason here, of course, is cost, that the power sector finds cheaper alternatives in other sources of fuel besides LNG. And the places where we have seen LNG demand growing in India, that's predominantly in the fertilizer sector. And the fertilizer sector has been heavily subsidized by the government. It's actually a fairly expensive subsidy because LNG is so expensive. But really, the growth in LNG has not been replacement of LNG for coal. It has been basically due to government subsidized purchases of LNG for a favored sector within the Indian economy. Getting back to the power question, as I mentioned before, LNG is not replacing coal in China's power generation mix. It is in China, the share of electric power that comes from gas has remained stable at about 3% over the last decade. In India, the share of gas in the power mix has actually fallen below 3%. And the reason, I think, one big reason for this is this chart. It shows the price of different sources of fuel that China could use for electricity. And the big orange bar is domestically produced coal, which is, of course, encouraged by the central government. And the price of which it comes in at, around a little under $5 per MMBTU versus the price of natural gas, and in particular the purple bar, which is LNG, which was nearly 3 times the price of coal. And really, if you look at the history of the U.S. when gas was replacing coal, which did happen in the U.S., that was when prices were falling below $5, and then even that transition away from coal was supercharged when prices fell below $3. You're not going to get that with LNG because LNG is simply too expensive to displace the coal that is currently being burned in China. Meanwhile, what we have seen replacing coal, or sort of eating at least into the market share of coal, has been solar and wind, where in China, deployment of solar and wind has basically quadrupled the share of power that comes from renewables over the past several years. This is not just our opinion. This appears to be the opinion of the IEA as well. Gas importing, this is a quote from their World Energy Outlook in 2024, where it says, gas importing emerging and developing economies would generally need prices at around $3 to $5 US per MMBTU to make gas attractive as a large-scale alternative to renewables and coal. But delivered costs for basically new LNG projects need to be around $8 per MMBTU just to pencil out, just to break even. So this suggests why LNG is not replacing coal in India, not replacing coal in China, and it has dimmer prospects of replacing coal elsewhere in the developing world. So maybe it's not the two behemoths. Maybe the demand will come from smaller economies. Here's a look at Pakistan. Now, as people may remember, during the Ukraine crisis, Pakistan found it very difficult to obtain supplies of LNG. It suffered some severe currency problems because it was depleting its currency reserves to pay for LNG that it contracted for. This LNG dependence actually led to severe energy insecurity and high power costs in Pakistan, and in 2023 led the government to halt new LNG to power projects. There were rolling blackouts, there were rising prices for power, and at the same time, solar power the price of solar power and solar power deployments was falling. This has led to a surge in new solar deployments in Pakistan that has reduced electricity sales from the grid by about 10%. And in fact, we've seen fairly recently, Pakistan is now reselling cargoes of LNG that it has purchased and cannot use. This is again from an economy that was at one point, about a decade ago, was seen as one of the big growth markets for LNG. Now they literally have too much. They've delayed purchases of Qatari LNG from 25 to 26, and in 25 they're trying to resell cargoes that they've already obtained. Okay, another economy, Vietnam. We are probably going to see incremental growth, at least some incremental growth in LNG demand in Vietnam. But at one point, Vietnam was posited to be one of the main sources of growth in demand in Southeast Asia, which is one of the big places where we're going to see a lot of demand growth in LNG. Demand growth has evolved much slower in Vietnam than I guess the LNG industry had hoped, largely because of delays in moving projects forward. There is a new the new non-truck facilities 3 and 4, which started up after 8 years of development. But fundamentally, the power contracts and the purchasing agreements with with Vietnamese utilities are developing very slowly. It takes years of careful negotiation between counterparties just to get those agreements signed because the public utilities that are buying gas in Vietnam do not want to be uh, basically on the hook for buying expensive LNG in the future. They're looking for price stability. They're not sort of providing sort of a standard power purchase agreement um, template or contract. These are sort of one by one negotiations between sellers of LNG and importers. It's been a very slow process in moving these projects forward. It was once seen to be a bright spot for demand. It will probably grow in Vietnam, but at a relatively slow level because of the delays we've seen in moving these projects forward. So what we have here? We have a picture of an enormous amount of new supply coming online around the world. And we're seeing problems with the thesis that the world's LNG appetite is growing at the same pace as the supply is growing. We're not seeing it really in the developed world, in the developed economies. We're not really seeing it in India, China, and in many of the other smaller economies that were once seen as sort of the engines of LNG growth in the market. But I want to emphasize that it's not just IEEFA that has seen this. We've published several reports on like outlining the glut and the potential for oversupply in the global market. But this seems to be becoming a widely held view among independent analysts. Not so much, you don't always see it from gas companies or LNG companies themselves, but the independent analysts who are trying to help investors figure out the trends in the LNG market are starting to say things like, we're going to see an unprecedented surge in new projects that will tip the balance of markets, an oversupply reaching multi-decade highs over the coming years. That was from Morgan Stanley. S&P Global Commodity Insights last year said, oversupplied market, current overinvestment cycle is expected to keep prices for long-term contracts under pressure. This is a quote from the Oxford Institute for Energy Studies. They have been predicting a peak, a glut of LNG in the late 2020s, and potentially a peak in demand in 2030. We don't necessarily at IEEFA share this view, but it is clear that there is a widespread belief that there's oversupply in the market and not enough demand to absorb it. Perhaps the most I guess sort of the biggest example of this was the ICIS that recently came out with a view that the LNG market globally was going to be oversupplied for about 11 years, with a significant amount of oversupply from 2028 to 2032, with significant volumes of capacity that is basically not necessarily going to be needed by the market. So, okay, I painted the position, the picture of rapid supply growth, weak demand growth, and a growing consensus that there is going to be too much LNG in the market. Well, how does the market respond to oversupply? There are really two responses. One is prices have to fall in order to clear the market, or supply have to be curtailed in order to match supply with demand, because those are sort of the only two mechanisms that the industry has: either accept lower prices or trim some supply. Uh, this creates a problem for the industry, and it creates a problem for investors who are looking to figure out who is going to get burned by a glut. There are a lot of different players across the value chain that can get burned in a low price oversupply situation. Those players is, frankly, it's new projects that are set to come online over the coming years. These projects, even if they're fully contracted, they tend to sell some of their cargoes early on, their commissioning cargoes, at spot prices. That's one of the ways that, say, a company like Venture Global in the US has made a lot of money. It delayed its commissioning phase for as long as it could, and it sold commissioning cargoes at spot prices into a red hot market. But if spot prices are low, then these newer projects that were counting on a revenue boost during the commissioning phase, they may actually see a real trouble selling their cargoes at a profit during that commissioning phase when they're sort of ramping up. Another potential loser in a glut scenario is the high cost projects that have high costs of gas supply, high costs of production, high cost of transportation, and in particular, projects that have with no committed buyers or not enough committed buyers, not enough contracted volumes to sustain further production, high costs. These are projects that may just simply get turned off or cut back. This is what we saw actually in 2020 during the depths of the COVID crisis, when many of the brand new US projects simply were turned off because, well, the price that they could get on the market was lower than the cost of getting it into the market. Another potential loser in this process is projects that have spare uncontracted capacity. That is, projects that reserve a certain share of their sales for the spot market, either for themselves or for maybe for their equity off-takers. Those spot sales can become unprofitable, and so the project with spare capacity can run at lower than optimal run rates. Obviously, in a low price environment, you may have traders who have committed to buying LNG from projects and then are forced to sell it at a lower price in the destination market, say buying LNG from the dock in the US, getting it to Europe, all in cost of $8 or more. If the price falls below $8, then they're losing money on those shipments. And of course, on the other side, on the buying side, long-term buyers who are paying more than their competitors. They're paying essentially indexed prices when they could have gotten spot cargoes for much cheaper. Those are again one of the players across the value chain who can lose money in a glut. So this, in my mind, poses a conundrum for careful investors in the LNG sector. That is, if there is an extended period of low prices that could last for at least several years, maybe longer, that is likely to shrink profit margins all across the value chain. That is, all the way from producers to ultimate consumers. With low prices, there's just less money to go around. When prices are very high, producers can make money, the gas companies can make money, the gas suppliers can make some money. Everybody can make some money when prices are high, but when prices are very low, that shrinks profit margins and creates really what I would say is a difficulty in pinpointing where in the supply chain the pain is going to be felt the worst. So in a sustained low price environment, if you have a broad-based bet on the entire LNG sector, that will fail to differentiate among the market players who stands to win, who stands to lose. This is, in some ways, it's somewhat similar to what happens when, the oil market gets oversupplied. When oil prices fall to 60, there's a lot of different players that are involved in that market that get squeezed along the way. Everything from refiners, producers, the transportation companies, with low prices, essentially, you have very slim margins, and those margins, and sometimes even no margins. And when there's no margins or slim margins, somebody often gets hurt. So what this means is that investors looking to get involved in LNG right now you can't just make a broad-based bet on the entire market. You need to have a fine-grained understanding of the value chain to assess which portions of the value chain are likely to be produce winners, or really who are the going to be the companies that lose the most. We've already seen just yesterday, Shell announced that its trading arm is going to be producing less profit this quarter than last quarter. That's what sort of corresponds to really a sort of like an easing in prices. Um, when prices go from today's levels down to $8 per MMBTU or lower, it's a real challenge for investors to figure out which of the companies that are going to be able to weather the storm, and which ones are the ones that you need to short or get or avoid in your portfolios. So let me just conclude here by giving you an overview. There's going to be a massive build out of LNG supply capacity over the coming 5 years, and that may last for longer as we're seeing new projects get FID'd, reach their final investment decision. Demand from the developed half of the market, the wealthy half of the global LNG market, is expected to be flat or down due to energy policies, energy security policies, price impacts, and climate policies. In developing markets, we are not seeing the kind of sustained LNG demand growth that the LNG industry needs in order to absorb all of the new supply. And this means that right now, most independent LNG analysts do forecast some sort of glut developing over the next few years. In a glut condition, low prices will shrink profit margins all across the supply chain, from the gas producers to the LNG terminals, to the logistics companies, to the traders, even to the buyers, the ultimate buyers. There are fewer opportunities for profit when prices are low, and this means that investors face a real puzzle in figuring out who will be left holding the bag when prices do fall, if prices do fall as a result of sustained market glut. I will just point to a few of the reports that we have written on the LNG sector. The slides will be available after for folks who want to review it. And I guess it's time for questions now.
Thanks a lot, Clark. This was a super interesting presentation. I really learned a lot. And, for me, the arguments were always, you can generate revenue, you have big project scale, energy security, transition bridge narrative. So it's always the argument that is used to finance LNG and gas, global demand from Asia and Europe. And this is something I've been looking for reports that really show that global demand for years now, and there are not really the reports that really show it, interestingly. And also no other, Canadian specific issues that it's like indigenous economic partnerships that are often used as arguments, But I see, as you've shown, if you look at Canada, what are the risks here? We have environmental and climate risks, stranded assets in this field. Federal emission caps that we have here, methane regulations, that is another issue. Many of the projects as well have issues with indigenous rights, social license risks. It's not all these projects are really going well. Then, of course, the reputational risks that we see in the climate conscious market policy. Carbon pricing. What happens, if we have cross-border pricing or domestic pricing, market and financial risks, and geopolitical risks. I found it interesting, given the real shock in Europe, with the war, Russia against Ukraine, there should have been more LNG and gas. That was my guess, but it wasn't. You showed it really well. But I want to leave it with that as kind of a short comment, and please and give it over to Robert Soden for some comments, so that we have time for questions from the audience. Robert.
Great. Thanks, Olaf and Clark. So I think Clark's presentation, for me has added just a really important and really sobering um, piece of understanding of how we think about um, some of these issues. So rather than being kind of this opportunity for investment, as so many tend to assume in our sort of popular conversations about this, LNG does really seem to present a financial risk. Um, in addition to some of the well-known climate risks of continued investments in the sector that Olaf mentioned. I want to quickly try to connect some of this to work that we're doing here locally in Toronto at the Toronto Climate Observatory. So here at U of T, we conduct a lot of academic research, of course, but through the Toronto Climate Observatory, we're increasingly looking to provide public urban climate data and analytics to our local partners in government, private sector, and the nonprofits space. And one of our focuses really is not just on Toronto's kind of public and private institutions accountability for their sort of operational or domestic emissions, but also through the emissions that they enable through their investments in lending, particularly to these high carbon sectors that we've been discussing. And so last year, the Toronto Climate Observatory, we released a study called the Bay Street Climate Report, which you can find online, and maybe Richard can drop in the chat. And this looked together at the financed and facilitated emissions of our domestic financial sector here in the city of Toronto. And we used relatively standard methods, drawing from PCAF and a lot of publicly available data from Bloomberg, companies' annual reports, and so on. And the results were really striking. In total, these emissions of Toronto's financial industry were something like 100x the domestic emissions of the city of Toronto, twice that of Canada's overall. And so we really do have a lot of work to do, but also see this as a very important opportunity ahead of us to work together around tackling this issue and for Toronto to really meet its ambitions to be a leader with regards to urban sustainability. So last March, following the launch of this report, a motion was passed by Toronto City Council, acknowledging the urgency of these emissions, and recommending a number of ways that the city needs to get more directly engaged in solutions. And so the first recommendation of this report was around the establishment of a sustainable finance hub. So this hub would be a space where folks from academia, civil society, financial sector experts can come together to help address these very thorny issues like some of the ones we're talking about today. And this, we see this as really just a really important example of the ways in which there's increasingly regulatory and political pressure on FIs that we're seeing with regards to responsible investment, and this time coming from the city level. So we're looking for partners to be part of this process to help craft recommendations to the City of Toronto around the fulfillment of this motion, and to really be involved in the creation of this local finance hub. And I think this is a really unique opportunity to develop the kinds of collaborations we need between academia, local government, industry, and civil society on these important topics of sustainable finance. And so if this sounds interesting to you, please get in touch with me via email. You can just email Toronto at climateobservatory.ca. And we'd love it if some of the folks here were to get involved. It's increasingly clear, and I think Clark's presentation helped so much, that institutions need to move away from LNG and from the sector overall, both for climate stability, but also their own financial resilience. And so we're delighted to have been able to host today's discussion, and are really looking forward to this next section of Q&A with you all. Thanks.
Thanks a lot, Robert, and thanks for the connection to the Toronto financial industry. So I will start with the questions that came in. So the first question to Clark is, looks like the numbers are clear that you showed to us. So the obvious question is, why does the financial industry and government still support these projects?
Well, those are two separate questions: the financial industry and the government. So the government tends to support these projects because they believe they're going to get revenue from in particular from gas royalties. Sometimes they support it because they're going to get tax revenue from the projects themselves. So, so governments have one set of financial incentives or fiscal incentives, really. The bigger question is why are projects still sort of like touting themselves as sort of sure things in an atmosphere where there's going to be a lot of supply and potential, at least a potential for weak demand. Some of this is just optimism, right? Like it's a bet on long-term growth in the LNG market. We've seen growth in the LNG market in the past. We know that there's a lot of different places in the world that might want some gas, and so we think that this is a great opportunity. They may not be looking at all of the things that we've been seeing that have been suggesting weak demand growth in some of the major sectors. I think that the industry has convinced itself, frankly, that it is the answer to reducing coal consumption. This doesn't appear to have any basis in reality, but certainly if there were a big shift from coal to LNG, that would mean major demand growth for LNG. And so I think they've kind of bought into that narrative. So that's basically sort of like, it's kind of like the field of dreams narrative. Like if we build it, they will come, the demand will come. There's another way of looking at this, which is that LNG is not a bet on sort of demand growth, it's a bet on volatility. So we saw recently oil prices spiked, and there's a threat that natural gas LNG prices would spike during the Israeli and Iranian conflict. There's some fear that the Iranian government was going to close off the Strait of Hormuz. That would be that would create way more volatility even than we saw during the Ukraine crisis. I mean, during the Ukraine crisis, prices shot to 60 for gas, for LNG. $60 per MMBTU. During like a potential closure of the Strait of Hormuz, you'd see oil prices, so oil-linked contracts, LNG is sometimes linked to the price of oil. Those contracts would skyrocket. You'd see the price of oil, so the price of LNG skyrocket if you lose Qatari supplies to any appreciable degree. And that is when these companies make the most money. So rather than thinking of this as a bet on sort of a stable source of revenue into the future. Maybe it's a bet that there will be supply disruptions. There will be geopolitical turmoil or unrest that will cause prices to spike, and that's what's going to trigger the sort of the financial bonanza that they're looking for. There's a third reason, which is somewhat more cynical, which is that a lot of insiders, sort of the project developers, companies, private equity firms, individuals who've bankrolled early stage projects currently see the window of opportunity closing. Like they see a glut coming, so it is in their interest to tell the story of robust growth and how their project is great, because if it is really at the stage when the project is financed that the insiders get their payoff. It is not when they develop a successful project, it is actually during the financing phase when they take a portion of proceeds, give it out as executive bonuses or so forth. Like the bankers as well take their bonus when the loans are made, when the equity raise. When a company goes public, that's the time when the company's insiders get very wealthy. We've seen this again. We saw that with Cheniere in the early days. We saw it with Venture Global with very high executive pay for projects that just managed to get off the ground and hadn't actually proven themselves yet. So there's a lot of reasons. There's optimism. There's the volatility, the bet that this is actually a hidden bet on disruption of the energy system globally, and just frankly, it is the insiders may see their chances of payday fading away if they wait too long.
Thanks a lot, Clark. And there's another question on the producers. So which producers do you think are expected to get hit the hardest with falling LNG prices or supply curtailment? Of course, we are particularly interested in Canada with the new LNG shipments. So can you comment on that?
Yeah, it's hard to say for sure. This is not really my area of expertise. But in general, I would think that projects where there is significant uncontracted capacity. When I say that, let's say in the US context, in the US, Cheniere Energy sells most of its LNG on long-term take-or-pay contracts. And so these contracts basically guarantee a steady supply of revenue no matter what happens to market prices. Gas prices fall, LNG prices rise, it doesn't matter. They have insulated themselves from gas and LNG market risk by locking in most of their capacity in long-term contracts. That's not how every project works. There are some projects that essentially are designed to sell into the spot market. I think LNG Canada is a project, for example, that does not have a lot of long-term purchasing commitments. It does have purchasing commitments from the owners of the project. They're going to be taking their equity share of the LNG that gets produced. But the question then becomes, well, how much money can those buyers make? Those off takers from these projects make when they resell into a glutted market. And that depends really on whether or not they have advantaged purchasing contracts on the other side. So in general, look at a project in the US like a Golden Pass LNG, which is similar to LNG Canada in that they're relatively, as far as I know, there are no long-term contracts. It's basically sort of portfolio sales. If the market goes sideways, that project may get turned off because there isn't any sort of guaranteed off-taker. So my general sense is that on the supply side, it's like the companies that have a significant uncontracted position are the ones that are the sort of the biggest risk. Then there's the middlemen, the traders, who are basically they're market makers. They're buying LNG from projects around the world, and they're selling LNG to projects to buyers around the world. And those players could get caught, right? They may be committed to buying LNG at a particular price. Let's say it's Henry Hub plus 15% for transportation fees in the US plus a liquefaction fee of $2 to $3 per MMBTU. They're basically committed to paying at least the liquefaction fees and sort of on the hook for buying a fairly large volume of LNG. And they're reselling on the spot market. They're reselling it to whatever contract that they have arranged on the other side. They could wind up essentially with higher priced LNG that they're purchasing, $8, or even if Henry Hub rises, they could goes to $9 or higher per MMBTU, and only be able to get 8 or 9 or even less than that on the markets on the other side. And so it's the traders, the middlemen, who those were actually some of the players who got burned during the last glut in 2018, 2019. We saw a lot of the traders trying to sell out of their positions. I think Centrica, Pavilion, a few of those other LNG middlemen traders who found that when prices fell, that was when they got squeezed. They felt the squeeze.
So, and that's a question here as well. So, do you think these traders are the ones that will be left holding the bag from the project Glut, or who else?
It depends. So it's a mix. It's basically kind of like the way I've thought about it is anyone who's long LNG, anybody who either owns LNG based on their equity stake in a project or owns the right to take LNG from a project where they're sort of committed to paying an LNG fee, a liquefaction fee year after year after year. Those are the places, the entities, and these are of course these are players that don't have a corresponding contract on the other side to buy the LNG at whatever price they want to pay. And that's one of those sort of tricks in this whole thing is that in some cases, the buyers of LNG are kind of indifferent to price because they get to pass that price on to their consumers. So ultimately, one of the ways that a lot of this stuff works out in the end is that consumers are paying higher prices than they could have if they had done some other choice, right? If their energy suppliers have made it. So let's say you're like an electric utility in Europe, and you're on the hook for buying LNG from the US due to a utility contract for a long time. You may be paying for that, even though if you could have gotten cheaper LNG from the market, if there'd been a spot contract, and frankly, even if they could have gotten cheaper LNG, cheaper electricity from some other source like renewables. So a lot of folks can lose. Sometimes it's a consumer, but sometimes it's the people who are long LNG. And then again, this requires a fine-grained understanding of who's got the contracts and what they're like. I'm not going to try to speculate on individual companies here, though.
Thank you. And so another question, there are many projections of a global energy demand increase due to AI. We know that, and we all use it. Could this lead to a new demand for LNG in developed countries in addition to other energy sources?
It could. I, based on IEEFA's research into the AI demand growth in the US, there's a possibility that you'll see higher levels of electricity demand in some of these developed countries, so like Japan, South Korea. Curiously, we saw in the midst of this LNG, sorry, in the midst of this AI boom in the US, you've seen a decline in gas burn in the first half of this year. And I think it just came out this morning, 1.8% decline over the first half of the year in gas burn in the power sector. So this bucks the trend. I think there's a lot of talk about AI and the sort of the massive amount of power that it needs. And it's true. It is true that these data centers require a lot of power. There's also a lot of overbuild in the power in the AI sector, or at least proposals, double counting, you could call it, where in some places there's an AI center. Some company wants to build one, but they'll get bids from 4 or 5 different utilities to try to get the cheapest rate for power. And each of those utilities will say, here's the demand for one data center, when it's really just one data center overall is going to be built. So I think that there's a chance that we'll see higher electricity demand. Whether that translates into higher LNG demand, again, remembering that in most places LNG is the most expensive source of power, not the cheapest. I mean, like if people think about LNG as gas, LNG is not gas. It is heavily processed and expensive to transport gas. It has to be, it has to be sort of processed to a higher degree of purity. It has to be liquefied, pressurized, shipped across the world. It's always going to be more expensive than pipeline gas. So if there are places that have access to other cheaper sources of electricity, it's hard to see how LNG is the thing that is sort of like accelerated. Like you're more likely in China, you're more likely to see more coal, which is what is exactly what's happening right now.
Thank you. And maybe one more question that's kind of probably from someone from the financial industry. Given the gap identified by EIA and others between falling costs in the glut and the need for higher break-even prices, how do you see financing trends for new export projects shifting to bridge the gap? So away from traditional debt financing towards more equity, private equity investing. Is there a trend?
Yeah, that's what I was going to say is that one example of this is in the U.S. context. It's Woodside's Louisiana LNG project that was taken without any contracts. It was basically sort of like an equity focused acquisition of Tellurian, and then like an FID where they're basically they're riding on equity. They're looking for equity partners. So my sense, looking at this, is that lenders will want to see higher rates. They're going to demand higher interest rates for these projects. And as a result, that makes equity look a little bit better. And some lenders may actually just be saying, "Hey, look, I'm going to take a pass on this one." They're going to have to get much choosier about the projects they're picking. Um, so I think that the shift to more equity and PE financing may be one that we'll see, but that's we're gonna have to see how the market develops. I think we're starting seeing signs of that, but the biggest question in my mind is really, it's almost like a political question. Trade threats leverage higher levels of investment in the U.S. or even in Canadian LNG projects? I'm seeing right now is signs that the glut is going to get worse because there's been a lot of new contracting activity, a lot of new pressure in Canada to build out LNG projects as an outlet for Canadian gas. It doesn't rely on U.S. markets. A lot of pressure in the U.S. to sort of basically appease the administration. Um, that just continues the overbuild. I mean, if it is true that there is going to be an oversupply of gas, then the politics of this are not going to help the industry. The politics could actually make it harder for the industry to thrive in the long haul.
Thanks a lot, Clark. I think this is very informative, and I think also from the Canadian perspective, we are free to think about what we do with regard to the LNG project. So unfortunately, we're out of time. Thank you again, Clark, for your great presentation and for the great responses. Thank you to the co-host, TCO Corp, Georgia Family Foundation. A recording will be sent out to all those that have RSVP'd, and we send a PDF of the data filled slides as well for those who are interested. I think there were some who were asking for these slides. Sorry we could not get to all of your questions. I think you can find Clark, let us say it like that. And if you have questions to him, I'm sure he's happy to answer the question. If you're interested in being involved in Toronto's Sustainable Finance Hub, there's a link here as well. And so, yeah, thanks again to everybody. Thanks again to the participants, and I hope you had a great informative webinar. I wish you a great rest of the day, and with that, we will conclude the session. Thanks again, Clark, and all those who made this
Thank you.
webinar.
It was a pleasure.
Possible. Thank you.